I'm always joined by Dan Nathan. Dan, how are you?
I'm doing great, Guy.
Man, that was right to the point, succinct. Danny Moses, how are you?
I'm good, Guy. I'm really sorry about your Yankees, but it was a good run while it lasted.
The folks at home, if you're listening to this without video, you will notice that Danny actually perked up in his seat, so excited to give me the sort of razz about the Yankees losing in the World Series to the superior Los Angeles Dodgers, who emerged victorious, I believe, for their 8th World Series championship.
Guy, you are a very gracious fan of your team.
You lose.
Yeah, no, you are. And you always give a nod to the better team.
They were the better team.
Yep.
By the way, Dan spoke with Cameron Dawson, which people love to hear what she has to say, the CIO of NewEdge Wealth. So stick around for that.
Yeah, we had a great conversation, by the way. She helped me understand a little bit of what's going on with this interest rate volatility of late. She gave her outlook for equities into Q4 and possibly some of her indications for movement in 2025. And then we talked about a bunch of other stuff. So stick around for that. Yeah.
So
let's not forget, she was the recipient of the second ever Edward A. Moses Financial Scholarship from Rollins College. Let's not forget that.
Oh, so we'll put that in the show notes, Danny, as they say. No, how could one forget that? Now, as we're sitting here, it's Halloween, and we're actually, I don't know if I'm doxing us or not, Dan, but we have an office right off of 6th Avenue on 18th
Yeah,
Street.
that is a little bit of a doxing. But
6th Avenue on 18th Street. I mention that because on 6th Avenue, there's the Halloween parade that takes place.
Correct.
And it goes for probably 15 or 20 blocks. I mean, it's insane. They're expecting like 1 million people. And if you look at the barricades out there, it stands to reason that they'll probably get that. I mention that because during the parade, people will put on a reenactment of the Thriller video. It's amazing.
I saw some people practicing
incredible.
in Union Square last night.
Yeah. I mean, it's no joke.
Yeah, Danny's doing it.
Danny's doing it.
Yeah.
And it makes me think we have a bit of a thriller here in the marketplace in terms of what we're hearing from a variety of different companies, what we recently learned about Supermicro, which we will drill down, and what we're seeing, Danny Moses, in the bond market. Now, Dan spoke to Cameron about bonds, but I want to get your take on what's going on, because as we sit here, we had a 10-year yield which got through 4.3%, is either side, obviously has gone nothing but higher since the Fed cut rates. Thoughts on that, Demo?
You're going to love this, guy. So I'm only bringing this up to put this in context.
Please.
So the original Goldilocks story in the early 1800s was very different than the one that we know. The original Goldilocks story was an older woman in the house. The bears came in. She ran out of the house. So what we're seeing right now is kind of that type of Goldilocks scenario, meaning potentially rates moving higher. So we know the job number expectations are very low tomorrow. We've seen better economic data throughout this week. Inflation kind of in line. Yes, there were strikes and unfortunately there were storms, but the number's like 115,000 for tomorrow. So I think the fear going into this is that they're going to beat this. Then you obviously have the election. Whatever party wins, obviously people believe we've kind of ignored, but it's inflationary regardless, and or deficit rises regardless. So a lot of stuff being baked in, but I still believe this current move is just a stronger economy. And that's not a bad thing. If your economy is strong enough to offset, we're talking about 4.3%, 4.28%. But to your point, it's the direction which matters. And we got to find a level here to make people start to get comfortable. Because if we keep moving towards that 5% level, there's going to be a lot of discomfort in the marketplace for sure.
I think that's exactly right. And I think there will be a point that diminishing marginal returns where if yields start to go through, let's just say it's 4.35 or 4.4%, Dan, people will start to look at this and say, hey, this is more than just economic growth now. This is something else. And the backdrop for equities, which has been good up until now, might not be so good going forward.
Yeah, so your up until now is just some of the Mag7 reporting and some of the knock-on effects and some of the kind of extrapolating a little bit to this generative AI ecosystem. As we're talking right now, the NASDAQ is down 2.5%. We're about an hour and 25 minutes from the close on Thursday. There's not too many days in 2024 where we could look back and say there was a down 2.5% move in the NASDAQ approaching down 2% in the S&P 500. So it kind of, to to me, demonstrates how crowded these trades have been. And if you look, Cameron and I talk a little bit about this, the concentration in earnings growth for the S&P 500, that's a big part of this. So if you're starting to see forward estimates come down for a Microsoft, an Amazon, a Google, that sort of thing, it will not portend well for the S&P 500. The last thing I'll just say, because you asked about interest rates, go back to late 21 and go back to kind of early 22. That's when the market started selling off long duration risk assets. And it was all predicated on the fact that the Fed was raising interest rates to battle inflation. You've talked about this for a while. If the Fed starts cutting too soon, then they are likely to kind of re-inflate inflation. And then you have to ask yourself, is some of the same activity that we saw in late 21, early 22 about to find itself,
reenacting. Yeah. I agree 100%. We had Loretta Mester on. She's the former Cleveland Fed chair, I believe, or whatever they call the title, president. She was on Fast Money earlier this week, and she thought the Fed should move 25 basis points next week. And, when she says things, I listen. But, Danny, I'll bring this up to you. And you brought this up in your notes. Mortgage rates, counterintuitively, are now higher than they were a month ago. So we're looking at rates that have been rising now for the fifth straight week. I think now stand at about 6.75%, up from about 6.1% or so a month ago. I only mention that because I think people were looking for some relief on the back of the Fed cut. They're clearly not getting it in mortgage rates, and we've talked about that. And if you start to see a deterioration in the job market, which I believe we will, Danny, I think the housing trade, which has been Teflon and bulletproof for a while, is going to start to come unglued.
Yeah, you're right. It's up from the low of 6.08 just a month ago to 6.75 almost. And that, people know mortgage rates move more with the longer end of the curve, not the shorter end. If you want to open up a home equity line, that's more targeted towards the shorter end. So you are hearing people saying there's a lot of built up home equity out there that could be tapped into. That's still the case, but certainly something to watch. And when you look at the kind of the Fed fund futures again here, we're now, a month ago, we were pricing in 3 cuts. We're pricing just over 1 cut in for the remaining. So there's only 2 meetings left. So 1 25 basis point cut, maybe 2 at the most. And next year we're down to 4 or 5. So all that's playing in. But the one thing that's been happening, which has been the real driver of this bull market, and a lot of things that I'm watching, are credit spreads. And credit spreads remain tight, even with the longer end of the curve moving up. So on a relative basis, corporate credit out there, ABS paper out there is all tight. And we'll talk about some of the names which have benefited from that. And listen, there's an article every day about money flowing into private credit funds. We've exceeded $2 trillion here, and it's growing, and it's going to be put to work. So you can argue that a year from now, 2 years from now, those are bad loans, but it's going to take a long time to prove that. So credit conditions remain very, quote, loose. And if that were to change based on economic changes, that's a big deal also. So something to watch.
It's interesting. That's been sort of like this off-ramp, I think. So, maybe in some cases, the dam has been broken, but it's found its way into sort of these tributaries, which have provided some relief to the towns theoretically downstream, which would have been affected prior, but for the fact that these offshoots in the form of private credit funds you just talked about are sort of soaking it all up. It's going to be interesting to see how it plays out. I look at the HYG, Danny. I've looked at it for a while incorrectly because it hasn't moved now for a while. It's actually been grinding higher over the last year or so. But if you're going to start to see, I think, some cracks in the armor, it's going to manifest itself in this ETF.
Yeah, for sure. And I would just make one comment to Dan's comment just on tech earnings as we kicked off. There was nothing wrong really with these earnings. Of course, they're going to spend more money on CapEx, but we're talking about expensive names of a market that's priced to perfection. So I remember the scene in, Remember the Titans when Ryan Gosling gets pulled and the father yells, "Why'd you pull him?" And what's her name? The young actress looks at him, "He's getting beat, that's all." Well, the stocks are just expensive. That's all. It's nothing to do with anything. So if you love these companies, these are going to provide great buying opportunities at some level. And you start to come into these things because I looked at these quarters and I'm not a tech expert at all, but these things had run. You can't take a $1 trillion, $2 trillion company trading at 30, 40 times earnings and expect, to Dan's point, made this many times, you're just not going to get that type of compounded growth over time. So still great companies, unlike some of the other ones, which we obviously get to. So I think in the context of all of that, we were due for some type of reset and pullback. Seems like an opportune time.
By the way, it was Hayden Panettiere was the actress that you speak of. I think she was married to like one of the fighters, like one of the Klitschko fighters from the Ukraine. But I digress.
Yeah, one thing about those quarters, and I think for Microsoft and Meta, and it was interesting that they were both on the same night because they both had some of the same issues. They had a deceleration in revenue growth, right? And that's what a lot of folks have kind of been waiting for. And, they kind of guided to CapEx that was kind of in line. And, Meta, kind of indicated they're going to continue to have heavy losses in this reality lab. So again, I think that's something for investors. They really want to see when those losses start to kind of abate a little bit. And, again, I think this is one of the best performing stocks in the Mag7 behind NVIDIA. I just think expectations were high for both. And you're starting to see, year over year deceleration, and you're starting to see, sequential deceleration. And that's the thing that could really put these stocks in a penalty box for a bit.
Yeah, it's not an indictment. We say it all the time. I mean, these are not indictments of the companies. These are amazing companies, but the market has bid them up to levels which historically, in terms of valuation, Dan, don't make a lot of sense. So when you have a Microsoft, which at its peak was probably trading 33 times next year's numbers-ish, or an Apple, for example, into the number tonight, which by the time you're listening to this, Apple reported. But, that's still a company that's trading either side of 30 times. It doesn't make a lot of sense. I mean, we're going to talk about NVIDIA and this super micro because I think it's a big deal. But again, it's more an indictment on people that are willing to pay prices that historically have never made a lot of sense.
Yeah, no doubt. I mean, Uber is another name, Danny, I'll throw in here because I know you're always looking through read-throughs for the consumer. There was some slowdown in some of the ride-hail activity. And think about it. If you are, the sort of person who's, constantly Ubering, eats, stuff or ride-hailing, that sort of thing, one quick way that you can cut back is, less Uber, more public transportation or walking or whatever it is. And so I think that's one I think you really want to keep an eye on. And, this one had broken out just a couple weeks ago, right after that robo-taxi event. It was up 10% when folks thought there was no there, and it's given all that back. And since the highs, it's down 20% in just 2 weeks.
I always wonder why people question when stocks are down, not while they're up. I get how momentum works. I get the flow of money that comes in, but it's amazing to me to listen to the pundits that are out there, and you've got all this momentum in the market, and then you get a check back day, literally the levels that you were just a few weeks ago. They go back and question, why were these things stair-stepping every single day? Yes, it's demand and supply. I totally get it. But to try to grow into those multiples is very, very difficult. So these are healthy, as Carter likes to call them, checkbacks, potentially companies that you like. These could present buying opportunities. So I'm going to try to be constructive here instead of piling on here to the moves in these names, but that duly noted.
No, and I want to talk about one group that's been unbelievable, and that's the airlines, but I'll just sort of segue into the volatility index in the form of the VIX, Dan, because obviously the VIX was nowhere for the longest period of time, and quite frankly, rightly so, given it went over a year and a half or so without the market seeing a 2% move. Obviously, a lot changed in early August, and you saw the VIX trade, I think, either side of 60 and pulled back. But I've thought for a while, incorrectly until maybe today, that there's going to be another round here in this VIX. As we're sitting here, you have a VIX approaching 23, which is the highest levels we've seen in a while. So people will say, you know what, guy, that's pricing in the election, is pricing geopolitical risk. I get it. But the VIX is getting off the mat for the first time since early August.
Yeah, so to your point, if you take out that move that we saw in early August, and there was definitely some funky stuff going on there, you're basically at the highs of the last year or so. And again, election, there's a whole host of things going on. But I think the main point that you've been driving home for the last few weeks is the S&P was making new highs almost every day. And you have a VIX that's kind of, sticking around this 20 level. The long-term average for the VIX is like, or at least in the last, few years, has been in the low teens, right? So it just tells you people are getting hedged up. They're getting a little bit nervous for a whole host of different reasons. But I think to your point, when you see this sort of one-day move with the S&P down less than 2% as we head into the close, it tells you that folks are on edge here.
Airlines have been unbelievable, Danny. And, Tim Seymour in Fast Money talks about the airlines being trading vehicles, and he's right. But recently, you've had some breakouts, specifically in a name like Delta, which, again, today, Thursday, Halloween, made a 52-week high, north of $59. We're looking at a stock that's approaching, Danny, its all-time high that we saw in January of 2020, which was north of 62. So the airlines are seemingly telling a much different story about a consumer that I still feel is a bit strapped, but the airlines are saying something else.
Number one cost input, well, not number one, a large cost input for the airlines is oil, period. And Delta and United are two of the airlines, not many do this, that do not hedge out their oil risk. So they're getting the benefit of this move down. So that's why you would obviously see that occur. These companies are still very levered, obviously, and they've done a good job in the last few years trying to clean up their balance sheets. And it's really interesting. These charts are right back where they were right before COVID hit. So this is going to be a really interesting level. They're in January 2020 levels right now, or in and of around. So listen, I'm not saying you short them, but I will tell you this. If you are doubting, or if you think we were going to have a soft landing in the economy, these things are priced to planes fly around the world and never land. This is a no landing scenario. I do think also the Boeing issue.
Well, that's what I was going to ask you next. So let's talk about Boeing, because again, as we're sitting here below 150 again, obviously they had to do the raise. I mean, there's a lot of things not to like in terms of Boeing right here.
Well, I was going to say the Boeing issue, at least from a capital perspective, getting resolved near term is another positive. You could argue for the airlines in terms of future plane deliveries and so forth, because those two happen to be tied to Boeing as well. So yes, listen, we talked about this on the Monday on the tape. They were in the midst of pricing it. I mentioned that they definitely had already wall crossed these institutions. The big banks were in there. We saw the stock drift kind of the mid 140s a week ago. Lo and behold, where is it priced? 143. They had talked about they needed $25 billion over 3 years. They did it basically in a day. They were basically staving off the rating agencies. They did a good job of that. Now what are you left with? You're left now with a company that still has a lot of work ahead of them, that I believe is still expensive, still going to have issues, but took the downgrade off the table, most importantly. But again, I'm a buyer of the debt, not the equity, and I potentially would obviously buy the preferred equity versus the equity, but hopefully they get their shit together. And by the way, the strike's still not resolved, so it's costing the money per day. So temporary Band-Aid potentially on what is a big, very large flesh wound.
If it wasn't for AI being sort of the huge story of 2024, I think the big story would be GLP story and names like Eli Lilly, Dan. Now, Eli Lilly made its all-time high earlier this year. I think it was earlier in September, around maybe late August, around $972 a share-ish. It had a huge run to the upside. Like many other things, it sold off on that August 5th day, but it got it right back within a day or so. But as we're sitting here, we're coming off what was a very disappointing quarter, and more so, some of the commentary out of the CEO, who was seemingly unable to explain some of the things that were going on, I think has the market, I don't know, a little concerned. We're talking about a stock that traded down to, I believe, 775 or so in August, bounced back, made a new all-time high. We're trading about 840 or so. My question to you is, the bloom off the rose, and is now valuation going to be concerned, do you think, around some of these names?
Well, I think for Lilly, I think the issue here is that you have these compounders, which are much cheaper, right, than the name brands that are from Lilly and Novo Nordisk. And so to your point, Guy, I mean, Lilly, was trading at a ridiculous valuation. It was basically pulling forward tons of, excitement about these drugs and their ability to kind of go into other countries and the like here. But the compounding has done a number here in the U.S. So you had disappointing sales, not something on anybody's bingo card when you think about. So this was one of those mega trends, you put it right up there, much smaller than generative AI, but there were so many other knock-on effects. And we saw this in consumer products and restaurants and, all these other things. So the Lilly, because of valuation, I think stays in the penalty box. Novo looks very interesting to me. It had already sold off 25% into the Lilly number. And I know they're going to report next week. The stock gapped down 4.5%. This was on the day that Lilly gapped down, 10% or something like that. But it didn't see a downtick for the rest of the day. It had a 6% rally off of those opening lows. So right now, the stock is less than 1% below right before the Lilly announcement. I kind of like this one. I think it's been de-risked and the valuation looks attractive. And I also think that these compounders, they're trying to get rid of them, right? They don't like them for a whole host of different reasons. So to me, I think Novo's an opportunity. I think Lilly probably goes lower from here.
It feels like, again, that 775 level is the level to look for in terms of Eli Lilly, which, by the way, it traded down to in the sell-off on Wednesday. Just let me say this real quick, because it's coming down to Mounjaro and it's coming down to Zepbound. Now, if you look at the two, Mounjaro did $3.1 billion of revenue in the quarter. That's up 121% year over year. You're going to see, oh my God, that's staggering. But the street, it's all about expectations, right? The street was expecting $3.75 billion. So it was a pretty significant miss. Again, Zepbound is a much smaller drug. They were expecting the street $1.75 billion. It came in at $1.25. So the two big names in that space disappointed on the sales front. And the CEO was really not able to articulate the reasons why, one of the reasons I think this market is selling first, asking questions later. But I do think, based on a number of different things, you're looking for a place to buy Eli Lilly here, not sell it. And real quick, I'll just mention this, Dan. A lot of analysts, their price targets remain the same. UBS, $1,100 price target stays the same. Truist, $1,029 price target effectively stays the same. I think Guggenheim lowered a little bit, but it's still $9.55. My point is, analysts aren't running from the name.
Yeah, and Danny, maybe you can help us think about this a little bit, because like the generative AI stories, there's probably about 20 stocks that have really benefited in a meaningful way from a market cap standpoint. When you think about Lilly and Novo, there was only 2 stocks, and they at one point at their highs were nearly $1 trillion in market cap. Lilly was trading at a multiple it's never traded at. And one of the things about this Novo is, expected 20% plus earnings and sales growth for the next 2 years. All right. And it trades about 33 times this year and 26.5 times next. It just seems very reasonable. And so until there's some meaningful competition, and it's no different than the way we've been talking about NVIDIA in a way, that this stock looks pretty reasonable. Lilly, to me, less so. It really comes down to market share and who these compounders are having more of an effect on. So Danny, comment a little bit on the concentration and the crowdedness of these trades, because a lot of them have been in the long short community, right? And the hedge fund community. And when you see them kind of get unwound, when you see companies start guiding down, that's not the point in which to buy them, because this was a very big miss. And it was, to your point, Guy, it's not something you could put your finger on what exactly it was.
Yeah, as you can see, I'm probably the last person that should comment on these weight loss drugs.
Come on.
But secondly, I will tell you this in general. You think about the funds that are out there, the index funds, the passive, the large hedge funds, the large mutual funds. They have to buy big companies in general. So by definition, it's self-fulfilling that the thematic perspective, they're going to express it in these large companies. And therefore, you're going to have these overvaluations. People are going to pay a premium for them. That's exactly what you're talking about. There are other ways to kind of play these themes. It could be in drug delivery. It could be literally the shipping of the drugs. It could be in a lot of different things. It was in utilities for AI. So it finds their way around, but you really have to start digging. And this is the danger. The themes can work. Okay, here's my theme. I'm going to invest in these large companies. Great. But people have ignored and continue to ignore valuations at the expense of, you just want to be a part of the growth story. And so at some point, you just have some type of pullback, again, to go into what we talked about earlier. So that's really all that is. It's unlike, we're going to talk about a name I know here shortly that has structural potential legal issues attached to it. It's different, and you should stay away from those.
Let's talk about it right now, because you're talking about SMCI, and this is one that we've talked about on this show a number of times. That was added. It was announced that the S&P was adding them in early March. I believe the announcement was on March 8th. If I'm off by a day, please don't at me. But I think it was March 16th, in or about there, where the stock made a new all-time high north of $122. And we talked about it at length, how regardless of what metric you're looking at, it was an expensive stock and it didn't make a lot of sense. Fast forward, Danny, to what we've heard this week about Ernst & Young. I don't know if they call them that anymore. It's just EY, basically saying they had to resign from being their auditor. I find this to be a fascinating story with a lot of different tentacles. The first thing I would say is, who's responsible to be rigorous at the S&P to put them in the first place? And you talked about the potential for class action suits. You think about all the funds, Danny, that had to buy the stock, right, as part of the mandate when they were included in the S&P, and what's happened since.
I actually had in my quotes here, ambulance chasers. We always think about that for other things, but literally that's what you're going to have here. We've talked about this on the show, and the point that Dan just made, we said numerous times when this Hindenburg article came out and people want to go after short sellers and research. Well, you could have looked at that, what he wrote, and you could have said, well, I disagree or I agree with it, but it was worth exploring the reasons behind it. It turned out to be 100% accurate. And we said, go express your AI theme somewhere else. Why would you mess with this? We are down now, think about this, to an 18 billion market cap, to your point. But most importantly, Guy, we are at the same levels we were in January and February before they started guiding up, and they raised $2 billion, right, in March at effectively $87, $88, somewhere in that range on the split adjusted level to where we, relative to where we are now. And Goldman placed this deal. But here's the interesting quote from Ernst & Young, right? I've never seen this before. We are resigning due to integrity concerns, unwilling to be associated with the company. Now, their fiscal year is June. Their fiscal year ends in June. Ernst & Young was brought in to audit the 2024. So they looked at it, they go, nope. So now I'm sorry, but you cannot own this stock here. And I'm not saying to go out and short it at all. You probably can't. Do not do that. But you really have to ask yourself the question, why would you remain in it at this point? So there's a lot. This thing's going to be a big story, in my opinion. And granted, it'll become less and less because it does meaningful to the market. But this is a poster child, potentially, of some of the issues that have occurred in this cycle.
Agree 100%. And, I look at NVIDIA, and SMCI is NVIDIA's third or fourth largest customer, right? So you start to connect dots, and then the relationship between the two CEOs. And, I'm a big believer of two things: where there's smoke, there's fire, number one. And number two, you sort of are who you associate yourself with over that long a period of time. So, again, I'm not saying to go out and sell NVIDIA here, but I have this sense that in early 2025, we're going to start talking about, remember back on Halloween when all this SMCI stuff came out and we should have connected the dots with NVIDIA? Well, I'm going to try to start to connect some dots now, Dan.
Yeah, and I guess the connecting of the dots, it doesn't have to be anything nefarious. And to your point about the CEOs, supposedly they've known each other for 30 years. And if you think how attached they are at the hip, because NVIDIA high-end GPUs go into the servers that say SMCI and Dell make. All right, so let's just look at the revenue. You just said that SMCI is 11% of NVIDIA's sales, about number 3 or 4. Well, over the last 3 years, look at the way SMCI's revenue has ramped. $6.5 billion in 22, $9.25 billion in 23, 22.5 almost in 24, expected to go to $30 billion next year. So now let's just go look at NVIDIA, and we know the story here. They've had this massive revenue ramp from, I think, 20 billion maybe 5 years ago, expected to be 125 billion this year and 175 billion next. So let's just say SMCI is a donut. Okay, let's just say there's been some funny business with revenue recognition and a whole host of other things. You could assume that SMCI's contribution to NVIDIA's sales are to go down meaningfully, right? So how do we get to a point where you start seeing a guide down from a company like NVIDIA? Well, NVIDIA has been investing in a lot of the companies that are buying their chips in the private market. And Danny, we've seen this before. Like, this is not too different. And ironically, Sun Micro, go back 25 years ago, their servers were some of the most important components to the internet boom, right? And they were doing a lot of vendor financing. And as soon as demand slowed down, as soon as demand slowed down, Sun Micro had obviously less sales, but they also had investments in these companies, and a lot of them went under, right? And so that's the kind of, if you want to make some sort of correlation between these two periods, you don't have to look too far. And, the thing about NVIDIA is just a handful of people on the internet who are trying to put these points together. But I think at some point, there's going to be maybe another situation like SMCI, and it doesn't have to be as nasty as this one, but one of their big customers is going to guide down CapEx. And this story, the fever will have broken, in my opinion.
Listen, you're mentioning Sun Micro. It was Lucent and Nortel as well that were doing the vendor financing. All about what? Building out internet, building out fiber. It was the right macro trade. And there was plenty of winners and people over their skis in terms of no one was looking at balance sheets, to your point, Dan. No one was looking at accounting. They just wanted to be a part of the trade. So it's a great wake-up call. And we're all old enough to know exactly what happened then. So do your work. And is it an indictment on NVIDIA? No, but it's a wake-up call to say if there's a couple of these other, even if they're smaller players, and if they're 1% of NVIDIA sales or 2%, it could certainly cascade and ask the question. But again, it's the law of large numbers when it comes to these companies and the Microsofts and the Metas. What you're going to see, you just can't continue that type of growth in the cloud. You can't continue that type of growth. You're outstripping either demand or supply in the case of these data centers. But at some point, you're going to take a deep breath, and that will come one day for NVIDIA. And it's amazing that the stock, I will say, I think we're all kind of surprised that we had to bounce back from the mid to high 90s up to this kind of 140 level. And again, we're not saying go out there and short the stock, but again, just be honest with yourself when you're looking at this thing from a valuation perspective.
In March of 2020, there was a stock that cascaded down to $25 a share, only to see it, Danny, move up to approximately $361 a share by August of 2021. From there, the move down to $10 was fast. And as we sit here today, it's gone from basically $10 a year and a half or so ago to current levels of $252. That, of course, would be Carvana. And I mention it because if you watch any television, there's a very good chance you'll see an advertisement for this company. People have loved it. People have hated it. Well, everybody loves it again. But you're seeing some things, I think, in the report that are giving you pause.
For sure. Not involved in the name, have not been involved in the name for a long time. So I kind of ignored a little bit. And then on days like this, I have to take a fresh look. So I'm taking a fresh look at this. I know 95% of people that are listening are not going to do this, and that's fine. That's why we're here. The 10Q, which comes out quarterly, came out. And on page 15, on note 8, they took a $224 million gain related to what? Selling of loans. That's fine. I opened the show by talking about tight credit spreads, talking about how loose the credit markets are and how tight these spreads are right now. And they're taking advantage of that. Except you should know they can make certain assumptions when they transfer it. So when you think about a $224 million gain in one quarter on 100, what I believe, Dan, check me if I'm wrong here, 133 million shares outstanding, you're contributing way more than what the earnings were that they printed, right? And you can look at this thing on an EBITDA if you want, but let's not forget who Ernie Garcia 2 and Ernie Garcia 3 are and how they've been around this industry. They are selling stock in the truckloads. I'm not saying go out and short it. It's a high short interest, but please, if you were smart enough to have bought the stock, and they did raise capital, they have bought back debt, they have pushed out their debt maturities. So there are some positives to this, but just understand this is not a true earnings number reflection. And the last thing I'll say is we all remember what Tesla and Hertz did, right? It's funny how all roads lead back to Tesla somehow. Hertz and Carvana have an agreement where Carvana sells these EVs. So we don't know the amount. We know it was a lot. They are the provider basically to offload all these EVs from Hertz. So that's real business. There's nothing wrong with that. But just know, like, some of these things are one time in nature. People, be smart on this thing and just take a look.
You bring up Tesla. It's interesting. So again, I'm not going to pretend I've been some raging Tesla bull because I have not. But when they reported earnings, what we talked about on a set of Fast Money, I think the stock was trading about 220 or so, Dan, was that the likelihood of it trading back to sort of 263 to 265 was pretty high, again, given a number of different things, given the fact that we had recently traded up there, and that's been resistance a number of times. Turns out that wound up being right. But as we're sitting here today, we've backed up a little bit down to 250. Now, there's still a lot here to digest in terms of Tesla. I think part of the run-up has been, again, since, April or so, some people getting their arms around a potential former President Trump victory and how that would benefit Elon Musk and specifically Tesla. So I think a lot of it is jockeying around the election. I think a lot of it is trying to jockey around this past quarter, which some people will say maybe finally they're turning the corner in terms of margins. But I look at it here and say, you know what? It's just been doing what it's been doing now for the last year and a half or so.
Yeah, I got to give Guy a lot of credit, Danny, because I was a bit dismissive. The stock was trading up, I want to say about 5% in the after hours while the call was going on. And Guy said, I think this thing gets going a little bit. The sentiment has been so bad on the name, and he thought it goes to 260, 265. And I just couldn't see it. I was chatting with you and Vinny and Porter, and you guys were breaking down the call. I'll let you get into that, but it just seems one of these names that's just highly manipulated. And when, Guy, you bring up the stuff about the election and how involved Elon's got, it seems like a very binary trade to me. We've been talking about their market share in one of their biggest, markets within, California. They just dipped below 50% there over the last few months. This is a group of folks out there were very early adopters. And then the other headline I saw out of China this week is that BYD, okay, that's a Buffett-backed Chinese EV in China, they just took Tesla, overtook Tesla as far as sales are concerned. So earlier this year, Elon, on one of his calls, he said that if we do not put trade barriers in place, then all other EVs around the world are going to get destroyed. Then he did an about face, and then he's come back to tariffs, right? And so it really has a lot to do, I think, with his relationship with Trump and the ability for them, for his thought that he's going to win. The other thing I'll just say about Elon for a second is that he's trying to become the shadow president. I mean, he cannot be elected. He cannot run for president because he wasn't born here. When you think about the tens of millions of dollars that he has contributed to the Trump administration, and Trump has kind of suggested that he would have a very big role in the administration. I think that there's a lot of risk to that, to a company like Tesla. I think there's a lot of conflict of interest as it relates to SpaceX and Starlink. So this is a pretty interesting situation. And then the question you have to ask yourself, if Trump doesn't win, you know what I mean? Where's this leave Elon Musk? So Danny, thoughts here, because maybe you could rip into the quarter a little bit, because you thought there was a bunch of funky stuff that got him to that earnings beat.
Yeah, it's just amazing to me that, again, back to the earnings that have been reported over the last few days, and Microsoft and Meta and CapEx that's going to be spent for future growth and all that. You look at the Tesla quarter, R&D below expectations in terms of the cost line, expenses below. It's horseshit, because they decide to give Tesla and Musk the benefit of the doubt, yet all he's done is fall down on all the promises the last 5 to 7 years that have occurred. So it's really amazing to me how you could have a manufacturing company that's going to launch new products and all this thing, yet no one questions their expense guidance or their current expenses. So I won't go into the capitalization of expenses and how they treat that. Just know that you had a CFO that left a little bit over a year ago, that was there for a long time, over a decade, that kind of left with a lot of people leave. Obviously, the company, and there's whistleblower lawsuits. I just want to remind everybody, the reason that Musk is cozying up to Trump is for many reasons, but I think the big one is he wants the agencies off his back, and there's many agencies that are kind of looking at him. So again, it doesn't trade on fundamentals, and that's always dangerous to me. I've said that for kind of a long time. But Dan, if the sentiment does shift, whether it's because Trump loses and he goes, and Musk has to kind of go back into trading on fundamentals instead of expectations into the future, then it's a whole different story. So again, it doesn't trade on fundamentals. I could break it down completely, but just know that it's still a very expensive auto company, in my opinion. Just leave it at that.
Before we get out of here, we have an election coming up. Obviously, we've sort of talked about it, but some of these trades I think have been predicated on certain outcomes. And I look at the banks, the outperformance in banks recently. I think I can point to the banks, or at least people getting long banks or betting on a potential win by former President Trump. I think the energy trade, which has been sort of very difficult, but I do think you're going to start to see a reacceleration there. But I think almost most interestingly is this move in Bitcoin, Dan, which I do think is trying to handicap the election, because for me, there's no other real reason for Bitcoin to have made this move, basically making a new all-time high earlier this week. So quick thoughts on that.
Yeah, so there's 3 trades that people have been focused on, right? So the idea with crypto, the Trump crew have been courting, this. They just thought this is a great way in with younger male voters, and it has been, no doubt about it. So I think a lot of it has to do with, getting back towards those highs, and those highs were made earlier this year because of the introduction of a whole host of Bitcoin ETFs, right? So you buy it in front of that and you see what happens. I think a lot of these trades become kind of binary. You could look at DJT, same way. It's had this massive run off the lows, and then you look at the prediction markets, right? So, there's been a lot of activity to the upside in all of them. I think they're getting spoofed, to be honest with you. Guy, you made this point maybe on one of our earlier calls. Does it influence, potential voters and how they think about their vote and the like here? And again, we have no evidence of this, but if you look at the polls, they're showing this a coin flip, neck and neck. And that's not what you see on Polymarket or these other markets, right? It's not what you see in DJT, and it doesn't really reflect what's going on in Bitcoin. So again, look at the move in the dollar, right? Like, that's not supportive of Bitcoin. So the whole host of things there. Danny, I'm curious on that, because this is something that I've been floating a little bit, like the idea that those 3 risk assets have been moving in a certain direction, which are really diverged away from the polls.
Yeah, I think, and the banks also, to a degree, that have had a nice run, and I think have held because of the fact that could be the result of the election. So listen, it's a very thinly traded name, DJT, and of course, Trump doesn't complain when the circuit breakers come in when the stock's going down, only when it's going up. That's a whole nother issue. But these polymarks and everything are very thin, and they can move. And I was talking to Isaac Boltansky yesterday, who is the BTIG Washington strategist, who we'll have on, soon. And he was basically saying everything that he was looking at was pretty much 52.48, 53.47, something like that. And he hasn't wavered really from that at all. So if you really want to be a conspiracist, and if you're the person placing these bets potentially overseas or not, thinking you can influence some of these trades that you're talking about, Dan, with a little bit of money, you can change people's mindset of how they're going to play the election out and trade these stocks in a way. So I'm not saying that that's what's happening, but people should be aware of this stuff. Crypto to me was already kind of moving up a little bit, certainly got the benefit from it, from a potential Trump victory. But I actually think the turmoil that might ensue is kind of the VIX, I feel like, is trading with Bitcoin just a little bit in general there as well. So, it's going to be quite a week next week. And listen, we also have still big earnings to come even before the election, which will probably get somewhat ignored. But, Guy, we got Exxon and Chevron. I think tomorrow, again, they're elephants. They're not going to surprise a lot to the upside or the downside, but just people focus on what companies are doing and try to, not ignore the macro, but pay attention to the micro.
No doubt. And I'll say this, before we leave and go to Cameron, I'll say, gold, the two big down moves in gold have taken place on days where the market is selling off in a meaningful way. August 5th, and you saw a downdraft in gold. And today, Thursday, Halloween, you're seeing a similar downdraft. And that's, to me, is just sort of a risk off across a swath of things. I don't think it's necessarily indicative of where I think gold is going. I'll say this as well. Gold's telling one story. If you look at the recent performance of Newmont Mining, which was a disastrous quarter in terms of performance, telling an entirely different story. But Danny, I think you agree with me on this one. The gold trade is still intact here.
Yeah, it's certainly intact. Again, these moves, maybe a couple years ago, it would be, call it 7 to 8%. We're seeing kind of 1 to 2% moves in gold. I think that the Fed fund kind of moving out and cuts being pushed out is really the corporate culprit here for gold, just on the margin a little bit. But yeah, I'm a buyer on every single dip here in gold.
We no longer do NFL picks because, as Danny said, if he was going to be brutal that 1 week, he was not going to go back to the well. So that well is now dry. So we will spare you. But what we're going to give you, Dan, is your conversation with Cameron Dawson, who, by the way, people really enjoy to hear what she has to say. So stick around.
Welcome back to the On the Tape podcast. I'm Dan Nathan, joined by Cameron Dawson. She is the CIO at NewEdge Wealth Management. Cameron, welcome back to the pod.
It's been too long. Happy to be here.
It was June, I think you were last on with us. And we're going to hit a bunch of really interesting stuff that maybe just Guy, myself, and Danny are not equipped to do. You are the one who has been very bullish for, I want to say, the last couple of years. You've been coming on, I think every quarter or so. We've been pushing back pretty hard on some of the themes. Some of us, Guy, Danny, and myself, we kind of diverged from that outright bearishness over the course of the last year or so. So really drilling down on some of these different themes that were kind of driving the markets. But let's do this. You are a prolific writer. I know that you do a lot of stuff on CNBC, which means that you are super transparent about your views. So here we are. It's October 31st. We're having a heck of a day in the market. We're going to hit some of that. I want to talk a little bit about your thoughts in and out of the election, how you're thinking about Q4, maybe some of the themes that you think are going to play out in 2025. The rate environment has a lot to do with it. The economy, it's kind of weird. It looks like on the surface pretty good. We know that sentiment is not particularly great, so we want to hit some of those things. Where do you want to start here? Because we're down 2.5% in the NASDAQ right now in a reaction to Microsoft and Meta's earnings last night. We haven't had too many days like this. So you want to just talk about the setup into quarter end? I know we're in the middle of earnings. Maybe we're like halfway through the S&P 500. Does that sound right? What's your vibe in general here? What are you thinking?
One of the things that's made us a little bit nervous about the last month or so of the price action is that if you break it down, one of the things you've seen is that, yes, the S&P 500 has rallied since those September lows and through October. But what we've seen is that it really has been just on valuation, meaning that through that time, you've actually been trimming 2025 EPS estimates. You've been trimming 4Q 2024 EPS estimates. And you've also seen this rise in yields. So all of the relationships that we would typically expect, if you asked us going into the beginning of the year, what are the two things, and we've been writing about this constantly through the year, what are the two things that could cause multiples to come off their high levels?
Right. And when you say trimming, you mean it's pulling forward from 2025, right? The multiple expansion.
Correct.
Yeah.
Well, so if we look at the EPS numbers for 25, they've gone from 277 a share to about 274 a share. But because the market has continued to rally, what you've seen is that the valuation has gone up to about 22 times forward. And so if we think about valuations and what drives valuations, there's a lot of things that go into them. It's everything from liquidity and sentiment, but also yields have typically played some kind of role, meaning movements higher in yields have typically been associated with a pull in valuations. It depends on the reason why yields are moving higher, of course, but also forward growth expectations, meaning that if you are seeing growth expectations rise, you typically are seeing multiples expand, which just means that I'm growing more confident about the future, and so I'm willing to pay more. That's interesting because what we've seen, as I mentioned, over the last month is that those forward earnings estimates are starting to get trimmed, but valuations are continuing to expand. So it's not too surprising for us to see a price action day like today. I'd caveat all of that by simply saying the trend is still very positive. And this market, the bullishness from this market has been one of just saying, you are not being rewarded for fighting this trend. Until we see signs that the trend has experienced significant damage, enough damage to suggest that we're going into a more corrective period, you have to respect the trend.
Right. And so let's just talk about where that trend in general has been driven by. Okay, so we've been talking about generative AI. It's been very concentrated. So the trade has been crowded, right? And so it's long onlys, it's long shorts. It's like, I remember hearing some of these billionaire investors just over the last month on CNBC talking about how this is a multi-year mega trend. Now, that's very different than the technology and how it's going to be integrated into different parts of the economy. And what actually this kind of, I think, goes towards what you were talking about is like, if we pulled forward a lot of the performance and multiple expansion over the last year or so among the hyperscalers and some of these chip makers and the like here, at some point the expectations are just too high. Like, how do you grow into them? So let's talk about that a little bit, because away from generative AI, away from, let's call it the Mag7, which have all benefited for the most part from this trend, where are you seeing, like, who's picking up the slack there, right? Because as of like a week ago, it was really interesting. Microsoft was a big underperformer relative to the S&P and the NASDAQ. Amazon was up in line with it. Google was an underperformer. Apple was just up in line. So really the only outperformance that you were seeing, and Tesla was down on the year, was from Meta and NVIDIA, right? So investors were already starting to trim those bets. And so where does it get made up in an okay economy in general?
Well, that is a really interesting question, because if you look at the constitution of earnings growth this year for the S&P 500, it has been almost entirely from those Mag7 names. Look at the third quarter alone. Mag7 up 18% is the expectation. Rest of 493 up just 0.1%.
Right.
Now, what's interesting is what you talked about, that picking up the steam, is that if you look then into the next quarter, what you have is that the street expects that 18% to stay about constant for the Mag7, but it expects the 493 to accelerate up to low double digits. And then you look into 25, what you see is this constant growth from the Mag7 of about that high teens, low 20s kind of growth, and a huge recovery in the 493, which just means that all of this hope about the broadening out is already pretty much reflected within the earnings estimates as they stand today. Why is that interesting on a whole nother level, which is that if you look at the earnings estimates for the equal weight S&P 500, they've been trimmed a lot more than the cap weight. So what we would view that big acceleration that's priced in effectively as a high bar, one that is potentially a source for downside disappointment. If any companies can beat to the upside and surprise to the upside, it's likely the Mag7, maybe not as much these 493. Then the caveat or the counterpoint to that is just to say is that those 493 earnings have been weaker in 2024. So they do have that easier lower bar effectively to jump over. But again, kind of reflected already where consensus is. So I think that's where the rubber has to meet the road. The 493 has to deliver. And if it doesn't, that's when you get this narrowness of the market returning. But then it comes with an interesting flavor, because what is different about 24 versus 25 is 24 earnings or 25 earnings for Mag7 are set to decelerate meaningfully. So how does the market digest a second derivative deceleration of about 40% for Mag7 this year to 20% next year? I don't know the answer to that, and maybe we're seeing it today.
Yeah, and so that's a great point, because after Q2, what we saw were forward estimates come down for a Microsoft, for an Amazon, for a Google. And so that decel that you're talking about, even though it's like way above like the 493 and that sort of thing, investors who are in growth and are fine to pay, high multiples for things that are at the forefront of a major secular trend. And this goes back to what I'm saying is like you pulled forward some of that excitement, right? Because yes, we all know that these growth rates are amazing off of very low bases, right? If you're talking about the sales of generative AI products for like a Microsoft, Meta is a kind of different story because they've integrated a lot of the spend from 2021 into 2022 into some of their generative AI, away from metaverse into generative AI. So let's just talk about for a second, Microsoft, okay, is talking about how their sales were less than some folks expected, high expectations, because they don't have the capacity right now. I'm not sure I believe that. And then the spending is like, has been rising or at least keeping pace. So that sort of dynamic is not particularly great. Meta, the same thing, is that they did not beat their sales growth estimates, but they kind of said pedal to the metal on spending, right? So once again, we are going to have forward estimates come down a little bit in this space. Is that enough for investors to basically say, you know what, we really have to trim this position because it is crowded? And a great example is like today, Microsoft's down 5.5%. The stock is only up 6% on the year on an S&P that's up 21%.
Yeah, and it's been something that we've been flagging to say, hey, Microsoft earnings estimates are only up 5% given all of this AI hype, and yet the stock was up so much based on just valuation expansion and that hope. And I think that one of the things we're seeing with Microsoft, of course, is that if you compare their cloud business to, say, Google's cloud business, Microsoft's cloud business is just that much bigger and more mature. So it's really not surprising to see a deceleration in a growth rate versus a Google, who has a lot more runway to grow and gain share simply because it's relatively more nascent. And you raised an interesting point about the return on invested capital when it comes to the AI spend. We know folks like Meta are pulling back on general expenses. Expenses actually fell this quarter for them, but that's all going into the AI spend. And I think that there's an interesting observation there, which is that AI at this point seems to be more, for at least the Metas of the world, driving efficiency in their own business, not necessarily a source of revenue or growth to the upside. The growth in ad spend, maybe you could say, well, AI is making ads better, even with the Apple privacy rules, and so that's helping them get this kind of growth. But I would argue that ad spend is kind of strong overall. Look at Snap, look at Reddit, look at Google. All of these companies, Snap and Reddit, are both 98% advertising. This is a reflection of a strong economy, not some grand business plan that's extraordinary. So I think that if we think about it just reflecting the strong economy, we go, okay, we see it, but now we actually have to see the AI deliver.
Well, and you make a great point about Meta is that they don't have the data center business. They don't have Azure. They don't have AWS. They don't have Google Cloud. So their spend has actually been a through line to the product in which they make most of their revenue on. That's advertising. And so the other point, I think is important to just focus on by the time you're listening to this, AWS we're going to have those numbers. Now, AWS bottomed out, I think, in like low teens. That growth rate was a massive deceleration as you saw Google Cloud, as you saw Azure take share over the last few years. So that one is going to be really interesting for me to see. That could be a total gut punch for this whole trade if they don't cross the bar that they're expecting. I think expectations are high there. All right, let's talk about, you mentioned yields. And Guy and I were talking earlier, is like in a day like today, you would have expected yields possibly to go lower. They're up a little bit. The 10-year is at 4.3%. Walk us through like how you were thinking about that, 50 basis point cut, a bit of a surprise in September. We still have high expectations for the Fed to cut 25 basis points. This would be, if you're looking at the CME Fed Watch tool, like I would have thought that would come down dramatically. It's Nov 7, so a couple days after the election. We're not even expecting for the election to be settled by Nov 7. So talk to me how you're thinking about what's gone on since the SEP rate cut. We saw that 10-year yield bottom at 3.55-ish. Here we are at 4.3%. I don't think anybody had that on their bingo card in the last month and a half or so.
Well, we put out a piece in September, late September, that said, hey, if the 10-year can cross above its 50-day moving average, which was around 380 at the time, look out above, because there's nothing stopping this from rallying at least up to the 415 level, which was the 200-day at the time. And if you break above that, then 450 is in sight. And if you look at what has driven this yield move higher, the two things, and maybe driven is the wrong word because correlation causation, but we've been flagging economic surprises and the odds of a Republican sweep or Trump win. And that those two things seem to be moving in similar directions, meaning that as economic surprises have been recovering since early September, we think that's been something that has driven yields higher. As you have seen the odds of a Trump win move higher, that has driven yields higher as well. Why would economic surprises matter for yields? We think it's because effectively the economy is telling you that the Fed doesn't need to do these emergency rate cuts. And we have been Fed dove doubters all year long. At 6.5 cuts priced in at the beginning of the year, we said, no way that's happening. We actually think that this economy is a lot stronger than expected. Of course, those cuts got priced out to be just one cut by the time we got to the late spring, kind of early summer. And then those cuts got priced back in as we got a couple data points that raised some eyebrows. You saw that weaker non-farm payrolls print that got people all flurried up. And then effectively you had the Fed extrapolating that into the September meeting to say, hey, there is evidence that high rates are weighing on economic growth, and thus we want to get rates back to neutral. And we think this whole notion of getting back to neutral is something that should be deeply questioned based on the performance of the economy through the entire time that this neutral rate or real Fed funds rate has been positive.
Right. Talk to me about equity risk premium. Is this something you track? Is it important to you? You just had this thing at go negative, right, where yields are relative to the dividend yield in the S&P 500. Is this something you track?
Yes, of course, because it matters for forward returns looking out 2 to 5 years. If you were to run a scatter chart of the relationship of valuations and 1-year forward returns, it just looks like darts on a wall. There's really no relationship. However, the lower you see either the absolute equity valuation or the equity valuation relative to bonds, which is what the equity risk premium is, the more stretched you see those measures, the lower the forward returns are in a pretty strong relationship once you start looking out 2, 3, 5, and then 10 years, which is effectively to say that today's high valuations are likely to eventually weigh on forward returns. It's not to say that we can't keep rallying. It's not to say that valuations can't go even higher. Of course, you lived through 1999 and 2000, but it's just to say that eventually it catches up to you. And of course, it comes with all these other questions and caveats, and I feel like that's the word of the day, caveat. Yeah. It comes with the caveats that obviously the market is different compared to what it was in historical periods. You don't really compare the market that was very weighted to lower quality companies in industrials and energy and materials back decades ago to today's very high return kind of tech companies. All that being said, we don't think that you can go so far as to say that the equity market is cheap or that these valuations are sustainable.
Yeah. And so let's go. You were talking about forward returns, and there was a Goldman piece, I want to say a week and a half ago or so, that was making the rounds. And I think it got a lot of headlines, but they're talking about the 10-year return return, situation was not particularly that exciting to them. So when you think about like forward returns, and again, this strategist, this group, they'll change their mind in a year from now, you know what I mean, on what that looks like. But I'm sure you got a lot of questions from clients. I know you spent some time talking about it on CNBC and the like. What's your takeaway from that? What, like, you as a strategist, when you hear, someone making that sort of call, what does it mean to you?
The first thing it means is that an environment of low forward returns does not mean to be uninvested. That's really important, because I've seen through my career people showing me different return projections and say, well, this isn't exciting, so sell all my equities. And what ends up happening is that in periods of low forward returns, that's actually usually the time that you get your generational buying opportunities, meaning that if you write off equities for the next decade because they're going to return 3%, you're likely going to miss the best opportunity of your life to be able to get into the market. So the first thing is to realize that periods of low forward returns typically come with higher volatility. The other thing to realize is that periods of lower forward returns typically come with big rotations in the market. Look at times like the 1960s, late 60s into the early 80s, huge rotation out of the Nifty 50 where the rest of the market did a lot better than the prior leadership. Look at the 2000s, terrible period for forward returns, but you had value really outperforming growth, emerging markets, small caps really outperforming large cap growth, domestic large cap growth. So you can have these opportunities to really make powerful returns if it is actually true that you have this period of low forward returns. The last point is that they could simply just be wrong. And I think that that's the lesson from the last decade, which is if you look at the last decade of projections, whether you want to use GMO or JP Morgan or Goldman Sachs, pretty much everybody agreed in their capital market assumptions. Lower returns for the US, and higher returns for emerging markets. So if you look at the US returns, this is JP Morgan's from 2014, and the foundation of the assumptions here are all very fundamentally sound. This is not saying that they did poor work, but they were just surprised to the upside. The expectation was for 7.5% returns. We got 12.5% returns. They expected about 9% returns for emerging markets. What did we get? 1%. So I think that we have to take some of this with a grain of salt. A decade is a very long time in market speak. And so you have to take and balance that strategic question with the tactical reality in which you live.
Yeah, let's talk about leadership for a second, because I think that's a great point. Like going back, a lot of folks have made that Nifty 50 sort of, passing the baton to some other groups here. But when I think about a lot of the narratives in 2022, right, about the prior leadership, this is when we started kind of racking up, just these $1 trillion market caps, like right before the top, in late 2021. And I think about off of the 22 low, we're up about 65% here. So again, that might have been a generational buying opportunity because some of the leadership have basically been, doing all the heavy lifting for all intents and purposes. But when I think about this whole notion that, normally it's a different group that leads into the next bull cycle, to me, and at the time in 2022, when a lot of folks were making that case, and they're making the case for maybe it was like international, maybe it was emerging markets, maybe it was different groups, more cyclical names in the S&P. I was like, it can't happen that way, because if you think about Microsoft, Amazon, Google, Meta, I'm missing a couple here. They are the market. Like they were 30% of the S&P, and so like if for them to just fall by the wayside, it's going to be a period of low returns. Like that was my point. So they did lead. And I would expect after some more digestion, they're going to lead again, because not too different. You just mentioned this. The NASDAQ took 14 years to get back to its prior highs from 2000, right? And so even in 2022, yes, the S&P was down 22, 23% or something like that. And a lot of those names, people forget, NVIDIA, Tesla, Netflix, Meta, they all sold off 70%. Now they're some of the biggest names in the market. So again, I think that tech mega cap is going to be the leadership. I think the trade probably broadens out, but we probably need a little bit fear put back in this sector. Does that make some sense to you?
Yeah, I think that it boils down to something that is relatively simple, which is that if you work backwards from what drives the leadership, it really has just come down to earnings. The fact that the Mag7 has led the market is not because they're doing some kind of magic and they have a hold on everybody. It is truly the fact that they have been the source of the majority of earnings growth for this market. And so unless you can make a case that earnings are going to significantly disappoint for this cohort of stocks, and I'd note, those earnings really did disappoint in 2022. Remember, Meta had its first down revenue year in 2022, and its earnings fell because it was adding so much in expenses. The stock fell for a real earnings reason that I think that the only way you see a durable rotation out of these large cap growth names is if you start to see a durable deterioration in their earnings growth potential. So we could then ask the question of what could that be? Could it come from regulation? I think that is the biggest question here, which is that these companies are near monopolies. They earn supernormal profits in some of their businesses. Does that have a bullseye on it for some kind of regulation that could hamper their ability to continue to generate free cash flow margins that are 3 times what the rest of the market is? Could we be seeing potentially a pull forward in AI kind of spend where they're overspending, just like they overspent coming out of COVID with hiring a bunch of people because of the growth they experienced post-COVID? That could be another driver. I think that the last driver of it would be just an appreciation that a lot of these companies are still very economically sensitive, and we've been in a good economic environment for them. Advertising businesses, that's a cyclical business. Companies spend more in advertising when they feel better about the world. Apple makes very high-end consumer products, cyclical business. Amazon sells consumer products. Somewhat, maybe you could argue there's some staples in there, but cyclical business. So I think that appreciating the cyclicality of these is also something to be aware of. The challenge is, do those companies also perform better if we do have a recession because they're just simply better businesses than other cyclical businesses? So
defensive, right? And that was the argument coming out of 2020 into 2021. And again, people did not have a whole heck of a lot of visibility about the health of the economy in 2021. But I want to go back to something, in 2022, I guess when the Fed signaled at the end of 21 that they're going to start raising interest rates to kind of battle inflation that they know, it was not created for goofy reasons. It was like the 100-year storm. It was a black swan. We threw fiscal and monetary and, the whole host of other things, broken supply chains and all that reshoring. So when you think about what happened, it made perfect sense that the Fed, they were offsides a little bit with that transitory sort of situation. But again, in hindsight, it was transitory. In the summer of 2022, we had a 9% CPI, and now it's, almost 3% or so. Cumulatively, I get it. It's hard on a lot of folks. But as soon as the Fed signaled that they're going to start raising interest rates, all of the names that we've just been talking about got absolutely murdered. So here we are now that a lot of people expected, coming into 23, coming into 24, that we were going to be, in a rate cutting cycle. So it started, but now it paused. Now rates are going higher. What does that mean for some of these long duration risk assets in general? Because we saw what happened in 2022.
It's a really interesting point because what it leads you to is realizing that there's 2 ways that monetary policy impacts the stock market. The first one is through the expectations channel. And the second one is through the real economy. And if we think about the expectations channel, it's the fact that as the Fed was signaling, we are going to raise rates to get a hold on inflation. What you started seeing immediately is people started cutting their forward estimates for things like GDP and earnings growth, which just meant that if you looked at GDP forecasts for 2023, for example, the market went from expecting 2% growth at the beginning of 2022 to a low of 0.5% 5% growth at the end of 22, and then had to revise it higher up to 2.5% or even higher, 3% growth through the course of 23 because growth was better than expected. Which brings you to your second point, which is that it's the real economy channel that I think is going to be put to the test. One of our key theses over the last 2 years has been that this economy is simply less sensitive to short-term interest rates than it has been in prior cycles. This is because of the long tail of quantitative easing. This is because of the ability to term out debt at very low rates. You see it in households, you see it in corporates, this ability to sustain and withstand higher interest rates in aggregate. It's not to say that some pockets of the economy aren't struggling. You see it in places like housing or auto demand in some places. So what we're questioning and what we don't know going into 25 is that if rates do in fact stay higher for longer because the economy remains resilient, 25 really marks a year that you start rolling over some of this COVID era debt in a more meaningful way. The average maturity of a high yield bond is about 5 years, corporate bonds 7 years. And so you have this question about whether, as you have to roll over this debt, if you don't get the rate cuts, do you finally start to see the real economy impact of higher rates? For right now, it's not happening. Look at GDP data earlier this week. The economy is cooking. And so we think that the thing that the Fed has not talked enough about is simply the different construct of the balance sheet of this economy and why Fed rate cuts have not been as impactful to slowing down the economy compared to what their expectations were. Because don't forget, the Fed missed on transitory, but the Fed missed also on recession with their own economists forecasting recession back through 2023 and then having to walk away from that.
You just mentioned GDP, 2.8%, okay, above, a whole host of folks' estimates there. And again, I mentioned the CME FedWatch tool. It's pricing in still a 93% chance of a 25 basis point cut on November 7th. Tomorrow, as you're listening to this, November 1, we're going to get the October jobs report, okay? So let's say we have hot GDP data. Let's say we have hot employment data, right? We added 254,000 jobs in September. Expectations right now are for 105 for October. Let's say it gets close to 200. Let's say they don't have any revisions lower, that sort of thing. What do you think happens to that 93% probability of a 25 basis point cut? And then if they pass on November and it prices out December, okay, is that is that a headwind for equities and valuations?
Well, I guess it depends on if Nick Timiraos is going to have to work through the weekend.
Yeah,
right.
Exactly.
Do we get a signal or rumbling from the Fed that, hey, we know that you have a 99% chance priced in that we're going to cut, but maybe you should change that pricing before we get to the Thursday meeting. I think that because they've signaled this desire to get back to some area of neutral, wherever that is, that they can justify doing one more cut this year and possibly two. But then there's really big questions as we go into 25, where that neutral rate actually is. Because if you look at the performance of the economy ever since the Fed funds rate has been above neutral, which is effectively going back to the end of 2022 is when we actually got above neutral. That's actually when we started raising forecasts for GDP, and that's when GDP started growing above trend. The same thing with that real Fed funds rate. You have Austin Goolsbee coming out and saying, look, we want to get real Fed funds rate down to because it's getting restrictive as inflation's falling. We think we have hundreds of basis points of cuts in order to get to neutral. The challenge is the entire time we've had a real Fed funds rate, which is since May of 23, the U.S. economy has grown above trend. I know there's long and variable lags, but eventually we have to start asking the empirical question of where is the evidence that these rates are significantly impacting aggregate growth. And it may just be you have to wait and see, but we do know the Fed could be playing with fire, given the fact that if they're cutting rates into a strong economy, so easing monetary policy into a strong economy at the same time as you have all-out fiscal stimulus, effectively big fiscal deficits, that does raise the specter, if you're just going back to Econ 101, of some kind of reacceleration. The thing that's saving us right now is productivity, though. Look at the productivity numbers yesterday. They were powerful, much above trend, which is just to say that we're getting the growth, we're not getting the inflation. There's a lot of things to like in this data. How long can it last?
Yeah, and the productivity stuff, if you believe in this shift to generative AI, it's going to help productivity a great deal going forward, or no?
I think that eventually it will. I would suggest that the productivity that we're seeing today is not a function of generative AI.
Yeah.
That the productivity today is as much of a catch up from the very poor productivity in 2020, 2021, and the reaping of the gains of productivity driving investments that we made really since the pandemic, where companies were forced to be more efficient because they couldn't get workers and they couldn't get what they needed. So I think that this is actually more of just classic great American blocking and tackling on corporate efficiency. Right. Eventually, we think generative AI could impact margins. And look, it's doing it at Meta, so maybe it can do it other places, but it's probably not showing up in the broad data yet.
Yeah, and I suspect, how this trade broadens out, it goes into different industries. Guys brought this up on a couple of occasions about a month ago. Walmart signaled that their better than expected e-commerce growth was benefited by investments in generative AI. A whole host of issues impacting that. It could be just from higher touch abilities from the technology that they're deploying, logistics. I mean, it goes on and on and on. So, I suspect we're going to see it in some industrials. We're going to see it in a bunch of other areas. But again, that's 1, 2, 3 years in the offing. All right, last thing before we get out of here, let's just kind of level set with caveats, okay? Because I think we could have a totally different conversation in 10 days, 2 weeks or something like that after the election. But it sounds like you are generally more bullish than most folks in your seats across Wall Street about the economy. Is that fair to say?
Yes.
Okay. As far as the markets, you've been very bullish for 2 years, as long as you've been coming on our pod. And there's been fits and starts, this past summer, little tantrums in this, but you see them as opportunities. But it seems like you've been a bit more cautious over the last couple months. And am I safe to assume that's because of the uncertainty in and around the election and how things shake out with the White House, in Congress in general?
I think that 2025, our base case setup in 25 is one where we say we appreciate where earnings estimates already are. We appreciate where valuations already are. And unless we too go into a bubble type environment, we're actually starting to prepare people mentally for the idea of a much lower return year. Now, arguably, you could have made that argument in 2024 at the beginning of the year.
We did, on the Tape podcast,
right? You could, and we thought that that you would get a little bit of upside from valuations and some upside from earnings, but it wasn't going to be as extraordinary of a year as 2023. Well, we underestimated it too, but I think that 25 is actually setting up to be a year that could look more like 2015 or 2018. And if you remember those years, the market didn't die. We didn't have some deep, huge, massive bear.
Well, the end of 2018, it was a nasty sell-off.
It was a nasty sell-off. I'll never forget that Christmas Eve. Yeah. But what you saw through the course of the year was a really wide range, a choppy range. There was opportunities to pick up stocks at different points in time when the market got skitterish and scared. You saw some leadership rotations. So what we're thinking for 25 is a wide, choppy, kind of low return year that's driven by the fact that you already have full positioning, you have full sentiment, full expectations on growth, full valuations. All of those things create a high bar. So I think it's a prudent thing to do as far as kind of lowering your standards a little bit. It's not to say that you have to sell all your equities and run for the hills. It's a very different message from that. What could surprise us? Well, look, the economy we know in certain pockets is on a thread. We know certain consumers are on a thread. We also know that this is still a tight economy, that if you go back to the 2020, 2021 inflation, inflation wasn't always and everywhere just a monetary phenomenon, not to offend any Friedmanites out there. there was a huge supply chain impact to that inflation. And that leads us to raise the question of, could there be supply chain disruptions in 2025 if you see big changes to tariffs and trade, as well as immigration? And those are wild cards that we can't handicap. We don't know what the plan is. There's talk about what could be done on either of those things. We also know that we have to deal with the question of potentially higher corporate taxes that could weigh on earnings growth. So regardless of who wins on November 5th or whenever we get the results, we think we have these wild cards to contend with into a high expectation world. And it's not just who wins, it's how the flavor that they win, meaning do we get a sweep of the ballot one way or another? And it looks like the market's pricing in a higher odds of a Republican sweep, which has a very different set of outcomes potentially than a either Democrat sweep, which looks to be very low odds, or a mixed Congress with a Democratic president. So all it's to say, we've been telling clients, just buckle up, buckaroo.
Yeah. Well, it's funny. If you go back to 2016 and the volatility in and around that election, the surprise of that, there was, pretty extreme. And then if you think about 2020, because of the environment we're in, the uncertainty of, COVID, and, we got a vaccine right after, and it was a very close race. There's a lot of volatility around that, but then it was kind of off to the races. So it's going to be a very interesting period. I think on the macro, it's about as clear as mud for me. If I go back and think about, all these different kind of scenarios and think about history and as it relates to yields, this is a very confusing yield environment. I think the way you laid out the valuation sort of setup here and what might happen to the leadership, I think that's really important to keep a close eye on. All right, Cameron Dawson, you made me smarter here. I really appreciate you coming on. Let's do it again with Guy and Danny once you have your 2025 outlook set up. That would be great for you to come back. Really appreciate you being here.
That would be awesome. Thank you so much for having me.
Thanks.